Compounding feels like a scam at the beginning, not because it actually is, but because it behaves in a way that completely goes against human expectations. You put in money every single month. You stay disciplined. You do everything right. And when you finally check your investment account, the growth looks painfully small. It doesn't feel like progress. It feels like stagnation. You start questioning the entire process. You wonder if you should have picked faster options, riskier baits, or something more exciting. And the worst part is, everyone around you keeps repeating the same vague advice. Just be patient. Give it time. It will work. But nobody tells you when it starts working, or why it feels so slow for so long. The truth is, compounding is not broken. Your expectations are. Compounding doesn't reward you in a straight line. It rewards you in a curve. And that curve is invisible in the early years. That's why most people quit too soon. They walk away right before the moment where everything begins to change. Imagine a person named Alex. He's 27 years old, has a stable job, and decides to invest $300 every month. No shortcuts, no speculation, just consistent investing. After 4 years, he checks his portfolio expecting something significant. Instead, he sees a number that feels underwhelming, somewhere around $16,000 to $18,000, depending on returns. His first reaction isn't excitement, it's disappointment. He starts thinking, I've been doing this 4 years, and this is it. That's the exact psychological trap where most investors fail. They don't fail because compounding doesn't work. They fail because compounding hasn't revealed its power yet. In reality, those early years are not about visible growth. They're about building the base that will later explode. Compounding is like pushing a massive flywheel. In the beginning, every push feels like it does nothing. It barely moves. But each push adds momentum. Slowly, almost invisibly, it starts turning faster, and then eventually, it reaches a point where it spins on its own, faster and faster, with less effort from you. That's the moment most people never reach, because they quit too early. This is where the 7531 rule comes in, a simple framework that predicts when compounding starts to feel real and how to structure your strategy so you actually make it there. The first number is 7. 7 years is the minimum time commitment you need to make if you want compounding to work in your favor. Not 1 year, not 2 years, not even 5. 7 years. Because in the short term, the market is unpredictable. Prices move randomly, news drives emotions, and volatility makes it feel like nothing is stable. But over longer periods, patterns emerge. Historically, longer time frames smooth out volatility and reward consistency. 7 years is where randomness begins to fade and the underlying growth becomes visible. If you treat investing like a short-term game, you will always feel like you're losing. But when you commit to at least 7 years, you shift from reacting to noise to benefiting from the trend. Think of it like planting a tree. You don't plant it today and expect shade tomorrow. You water it, protect it, and most importantly, you leave it alone long enough to grow. Digging it up every few weeks to check progress would kill it. That's exactly what people do with their investments. They interrupt the process and then blame the outcome. The second number is 5. And this is about structure. Most people invest randomly. They buy a few stocks they've heard about, maybe follow a trend, maybe react to hype, but they don't build a system. And without structure, consistency doesn't translate into results. The 5 represents 5 categories of diversification that create balance in your portfolio. The first category is broad market index funds, which should make up around 40% to 60% of your investments. This is your foundation, stable, proven, and designed for long-term growth. Instead of trying to beat the market, you become the market. The second category is dividend-paying stocks, making up about 15% to 25%. These are companies that generate cash flow and share profits with you regularly. They provide a psychological advantage because even when prices don't move much, you still see returns in the form of income. The third category is small and mid-cap growth stocks, around 10% to 20%. This is where higher growth potential exists, but with higher risk. These companies can significantly accelerate your portfolio if chosen wisely. The fourth category is international exposure, also around 10% to 20%. This protects you from being overly dependent on one country's economy and gives you access to global growth. The fifth category is defensive assets like bonds or treasury securities, typically 10% to 30%, which act as a stabilizer during market downturns. This structure ensures that your portfolio is not dependent on a single outcome, which is critical for long-term survival. The third number is 3, and this one has nothing to do with money. It has everything to do with psychology. There are 3 emotional phases that every investor goes through, and if you don't understand them, they will destroy your progress. The first phase is doubt, which usually happens in the first 1 to 2 years. Your portfolio is small, the gains are minimal, and you constantly question whether you're doing the right thing. It feels like you're putting in effort without seeing results. The second phase is frustration, which typically occurs in years 3 to 4. By now, you've invested a significant amount of money, but the returns still don't feel proportional. You expected more by this point, and impatience starts to build. This is where many people either reduce their contributions or switch strategies entirely. The third phase is panic, and it doesn't follow a fixed timeline. It happens during market crashes, when your portfolio drops by 20% or 30%. Fear takes over. Everything in your mind tells you to sell and protect what's left. But historically, markets recover, and those who stay invested benefit the most. These 3 phases are predictable, and the key to winning is not avoiding them, but preparing for them. You don't need perfect timing. You need emotional control. The final number is 1, and this is the most underestimated factor in long-term wealth building. 1 annual increase in your contribution. Just once a year, you increase the amount you invest, even by a small percentage like 5%. Let's say you invest $300 a month for 30 years at an average return of 8%. You end up with roughly $450,000. That's already impressive. But if you increase your contribution by just 5% every year, your final amount jumps to around $750,000 or more. That's nearly double the outcome, achieved not by higher risk, not by better timing, but by a simple habit of increasing your investments slightly each year. This works because compounding doesn't just apply to your returns, it applies to your contributions as well. Every increase builds on the previous one, creating a second layer of exponential growth. And the best part is, it doesn't require drastic changes. It can be as simple as redirecting small increases in income, bonuses, or cutting minor expenses. Over time, these small adjustments create massive differences. Now, let's go back to Alex. If he follows the 7-5-3-1 rule, commits to at least 7 years, structures his portfolio across 5 categories, prepares for the 3 emotional phases, and increases his contributions once a year, his results look completely different over the long term. By the time he reaches year 20 or 25, the majority of his wealth doesn't come from what he invested recently, but from what he invested in the early years. And in the final decade, the growth becomes dramatic. His portfolio starts increasing by tens of thousands of dollars per year, even if his contributions remain relatively modest. This is the phase where compounding finally becomes visible, and it feels like the system is working in your favor. But in reality, it was always working. You just couldn't see it yet. Studies from major investment firms consistently show that investors who stay invested for longer periods significantly outperform those who try to time the market. The difference isn't intelligence, access to information, or even skill. It's behavior. The ability to stay consistent, ignore short-term noise, and follow a structured approach is what separates successful investors from the rest. Compounding is not exciting. It doesn't give you instant results. It doesn't feel rewarding in the beginning, but that's exactly why it works. It filters out impatience, it rewards discipline, and it creates a barrier that most people are unwilling to cross. So if you want a simple plan, it comes down to this. Commit to at least 7 years. no matter what happens in the short term. Build your portfolio using 5 clear categories instead of random choices. Understand and prepare for the 3 emotional phases so they don't catch you off guard. And finally, increase your investment once every year, even if it's just by a small amount. That's it. No complicated strategies, no constant adjustments, no obsession with daily market movements, just a clear system followed consistently over time. In the end, compounding feels slow not because it doesn't work, but because it's designed to test you. It forces you to prove that you can stay consistent without immediate rewards. It challenges your patience, your discipline, and your mindset. But if you pass that test, the rewards are exponential. There is a point where everything changes, where your portfolio stops, depending on your effort, and starts growing on its own. Most people never reach that point, not because it's impossible, but because they give up too soon. If you stay in the game long enough, follow the system, and keep increasing your contributions, time does the heavy lifting for you. And when that curve finally turns upward, it doesn't just grow, it accelerates.